the shareholders, analysts and investment managers following Australia's twice-yearly company reporting season, the experience is typified as frantic and full of twists and turns. And this February was no exception. Hello, I'm Rebecca Jones. Welcome to the Bloomberg Australia podcast. This week marks the end of another ASX earnings season, and it's been a frantic couple of weeks. We've seen miners and the banks do it tough. Today, we ask, how do those in control of our biggest companies think things are really going? And what do the boffins, the analysts, have to say about that? Adam Haigh writes about finance for Bloomberg. He's based in Sydney and he joins me now to discuss this and also where to next for some of our biggest companies. Adam, it's great to have you back.
Thanks a lot. It's great to be here.
So, our banks, the big four banks, it's always at the forefront of investors' minds, and some of the biggest names this month were citing increased pressure on profit margins. Adam, what explanation did the bank CEOs give as to why this is happening and why now?
Well, what they did, Beck, really was kind of paint this picture of caution, this tone of caution on their own businesses, but also on the economy and how things are progressing from here. So clearly competition is heating up and has been fierce for some time. We've seen that in the mortgage market with home loans. But I think you saw it amp up a little bit in the last couple of weeks here with business banking and the fact that National Australia Bank, which has always been the dominant market player in business banking, see increasing pressure in this business, and the likes of Commonwealth Bank that have also been trying to eat into market share a little bit there, also showed you just how much of a competition fight is heating up in business banking as well. So really, if you look at some of the CEOs and what they were talking about, look over at Westpac, Anthony Miller, who's relatively new into the job there, of course. You know, he described their margin decline as modest, so not wanting to push too fine a point on the fact, not wanting to scare people, but just almost, put it out there so there's no ambiguity around the fact that there still is a difficult environment from here for the banks. And I think you saw that from the National Australia Bank CEO, Andrew Irvine, as well. There's a very cautious tone throughout really the period that we've seen in the last couple of weeks.
And how did the share prices react, Adam?
We've had some huge moves in the share prices. I mean, just have a look at last week's numbers. Westpac was down about 11%, Commonwealth Bank of Australia down a little bit more than 8%. NAB was the real standout, down 14%, which is, of course, a pretty big move. And ANZ, to a lesser extent, was still down 8%. So clearly some very big moves there. But I think you got to remember where a lot of these stocks have come from. And a lot of them were some of the real market darlings of 2024 and had a good run even in the early part of January. So a lot of that was just readjusting to these slightly reset expectations and a little bit of the froth coming out of them.
Yeah, I wanted to ask you about that. What are analysts saying about these banks and as they were sky-high valuations in the wake of these earnings updates?
Well, I think there very much is still a focus on just how expensive Australian banks are valued at in the market here. And I think a lot of the analyst commentary was around that. So you just have to look at the numbers. I mean, it's amazing, really. If you look at the MSCI World Banks Index, which is essentially a gauge of big global banks, you have CBA, NAB, and Westpac that are all in the top 10 of the most expensive banks if you use the price-earnings ratio metric of valuation, which really is just the stock price relative to what people expect their earnings to be in future years. So clearly these bank stocks are still very expensive, even after some of the reset that we've seen in prices in recent weeks. So you've had all this cautious commentary, and you've also had the nation's central bank lower interest rates for the first time in a good few years. And I think really that tells you the story of just it adds to the pressure on margins. And of course, all the big four banks followed up straight away after the RBA had come out on Tuesday and said, we're also lowering our home loan rates by 25 basis points. So the pressure is almost immediately being felt for the bottom lines for these banks.
We spoke to a couple of those CEOs shortly after the decision whose businesses are really relying on those rate cuts to start coming through. Wesfarmers, for example, they're one of the country's biggest employers as the owner of massive stores like Kmart and Bunnings. Without them, we, and I mean me, wouldn't have discount dupes and nice, tasty sausages to eat on a Saturday morning. Hey, only the important things on this podcast. Wesfarmers CEO Rob Scott talked to us on Bloomberg Television, and he said more cuts are going to be needed despite the RBA clearly watering down those expectations last week. And Adam, it's not just him, is it? We also had Tarun Gupta. He's the CEO of giant property developer Stockland. Let's take a listen at what he had to say about the cut and its impact on the demand for new housing.
Yeah, I think more cuts would be required to really see an upswing in cyclical demand. We are still, as I said, somewhere near the bottom cyclically. Volumes are down in most instances nationally about 50%. But it's about affordability and clearly at the moment there is a lot of pent-up demand and first home buyers are struggling to get into the housing market. To give you some stats, at the moment around 45-50% of our inquiries are first home buyers, but only about 32% are buying. So they can't afford to buy, but they have a willingness to buy.
So what are those two company results telling us, Adam, about the impact of rate cuts on big consumer businesses and how many more might be needed?
Well, consumers have obviously been suffering for quite some time and their purchasing power has been eroded away. Wages are not going up as fast as the prices of everyday things. And clearly that's one big problem that we're suffering in the economy at the moment. And you just have to listen to Rob Scott at Wesfarmers talk about that first RBA cut. He described it as modest. And implicit in that word, of course, is that the RBA should do more and would need to do more if you wanted to see a real uptick in consumer demand. And I think in a similar vein, the Stockland CEO, he's speaking to a topic of housing affordability, and of course we're heading into an election cycle now where it's a real important topic. And of course you don't have to go very far in Australia to before you get into a conversation about house prices with someone. And clearly they're looking for more from the central bank. They're looking for more. If you really want to get an upswing in cyclical demand in the housing market, Tarun Gupta is very clear that the RBA needs to be cutting more than just the 25 basis points that we had last Tuesday. But you only need to open your Bloomberg terminal, have a look at what markets are expecting and where market pricing is for interest rates in Australia over the next few months and through the end of this year. And really all you're seeing is perhaps one or two more cuts, maybe another 50 basis points in total of cuts. So that doesn't take us to nearly where places like the US have already gone to. So I think that is quite instructive and tells you that CEOs really want more from monetary policy, but also there's more from the government to do here as well.
I think it also does, of course, speak to the great amount of things that these CEOs cannot control. Of course, they can control a lot of the narrative, but this is definitely one outside of their sphere of power. Another one of those things is, of course, tariffs. And unsurprisingly, I guess, Trump's tariffs war was also front of mind for a lot of CEOs this earnings season here in Australia. Treasury Wine Estates, they make Penfolds, delicious wine, sold around the world. So it's unsurprising that their CEO, Tim Ford, had a bit to say on this very topic when he talked to us just after their results. Let's take a quick listen at what he had to say.
From our perspective, having such a large business that is in the United States, that is US wine, luxury wines that we make in America and sell in America, I guess for our company itself, we actually see some of the protectionist policy and tariffs that are likely to be put in place, if you believe that's what's going to happen, as a net positive for us as an organisation. Fortunately, we have a very big centre of gravity there in the United States.
So, Adam, that's one example of a business expecting a positive impact from tariffs if they're implemented, as Ford said there. Has there been much mention of tariffs elsewhere this earnings season, and what kind of impact are companies anticipating?
Well, this is the difficulty, Beck, with tariffs, is that, as has been clear in the initial few weeks of the Trump administration, is it's not clear what kind of ideas will become policy and how that policy will be enacted, and then the follow-on to your business. So if you run a big global business like Treasury Wines, which sells wine into all sorts of markets, not just Australia, of course, you need to be cognizant of making a decision, but then having to change that decision further down the line if a different policy gets enacted. So I think this is what Tim Ford was speaking to, the idea of let's just wait a little bit until we know a bit more. What do we know at the moment? Well, in his business, actually, people are just drinking less wine around the world. And that's really something more fundamental that he's struggling with. And at least he has the power to try and, do something to counteract that. At the moment, they just don't know enough about how the tariffs will play out to really get a sense of how to change their businesses accordingly. And I think you're seeing that. You're seeing this hesitancy from bosses, corporate bosses, really across all sorts of sectors.
When we come back, let's dig into, earnings from mining companies. This is the Bloomberg Australia podcast. And welcome back to the Bloomberg Australia podcast. You're here with me, Rebecca Jones, and Bloomberg's finance editor, Adam Haigh. And we are deconstructing hours of talking from the top brass at Australia's biggest companies as they report their half-yearly earnings. Did they meet our expectations? Why or why not? And what's next? Adam, it would be basically illegal to discuss earnings without having a look at the miners, so let's do that now. Our biggest miner, BHP, also the world's biggest, I might add, their profit was down 23%. They cited lower demand from China for iron ore. Not a shock there. Unfortunately, though, for shareholders, their interim dividend was also slashed to the lowest in 8 years. But hang on, their CEO Mike Henry says we've got to focus on the future. Let's talk about that, but first we'll take a quick listen to what he had to tell Bloomberg.
So we spent a number of years now building up that healthy pipeline, very strong pipeline of future growth options, predominantly in copper and potash. And as we bring those forward with the attractive returns that they have, we'll see the capital allocation framework that we put in place back in 2016 come to bear in exactly the way that it was intended, which is to protect the balance between cash returns to shareholders and reinvesting in the business. We do have a minimum 50% payout ratio, as you may be aware. And we've been paying well in excess of that for a number of years now, but as we bring these attractive growth projects forward, we'll see the two legs of that come into balance, and then for that pipeline of cash that we are able to apply into growth, there's a healthy competition between projects and BHP to ensure that we're striking or investing in those projects that are going to create the greatest value and greatest returns for shareholders.
Adam, how has the mining sector reacted to BHP's results?
Well, I think it's fairly clear that the slowdown and the continuation of this kind of deflation of the Chinese economy has been a struggle for some time now. It's continuing to have a material impact on companies like BHP, which clearly make a lot of money in China. And this is the real tricky thing for a CEO of that kind of a company. And I think this is why you saw a slim dividend there, is that they just want to keep a little bit more of a buffer now. That economy is still struggling, and indeed the global economy is still struggling. You now have this kind of next leg of the US-China tensions under the Trump administration. It's very unclear how that's going to play out at this point. And so perhaps prudently, a big global player in this space wants to just keep a little bit more capital as a cushion against any further deterioration in the outlook, and rather than handing capital back to investors, which they get quite used to, they've decided not to, and they've been quick to point out that yes, there might be certain signs of recovery in maybe the Chinese property market at the margin, but this is still an incredibly fragile environment, and therefore let's keep a little bit on the side for a rainy day.
And what are the analysts telling you about BHP's move to scale back the dividend and to look for future opportunities? Are they picking up what Mike Henry's putting down?
Absolutely, and I think they've these are men and women who spend a lot of their days studying how this company works, the supply chain nuances, everything that goes into the equation as to what kind of a price you want to pay for BHP shares today. And clearly the fact that they are not giving as much back to shareholders is a sign of, well, in the immediate short term, maybe we don't get enough, but is this a prudent thing that we're doing for the long term? So you did actually see a little uptick again in the BHP share price at the end of the week. And I think there are a lot of analysts who are kind of taking this on board as quite a sensible thing to be doing from Henry at this point. So we're very aware of the Chinese slowdown story. Let's keep a little bit on the side just in case things get a little bit worse from here.
So we've seen business banking and that sector, that segment of these big four banks growing in importance as each of these titans battle it out for our business. Some interesting reflections from the consumer-heavy outfits like Wesfarmers and those who build places that we live in and shop in, like Stockland, that more is needed from the RBA to get their profits up. And finally, BHP, as we've just been talking about, the big Australian, not invincible to the world around it. And even though, as my colleague in Bloomberg Opinion, David Fickling, described them as the least buccaneering of the miners, they appear to be steadfastly looking to the future for opportunities. Adam, finally, where is the ASX 200 as at the end of last week? Because we're not quite done with this week. And how is that going to bode for the weeks and the months ahead?
Yeah, well, there's no doubt it's been a tough little patch for the stock market, and of course, banks being such a big component of that, you've seen some of that filter through. But actually, financials, the broader category, which includes banks, are fairly flat actually last week. The biggest drags were energy and technology, and I think that does tell you a little bit about where we've come from with the stock market, and the fact that in 2024. If you remember, financials and tech were the
dominant
best performers last year. So there is a little bit of this unwinding of the winners, a little bit of the froth coming out of the market, people just resetting expectations a little bit. But I think it's important to remember that the Australian market exists within the global stock market, and the global stock market has gone through a bit of a fragile patch as well. You've of course had the RBA starting to cut rates last week, but if you look abroad, places like the UK, where the Bank of England's already had to cut numerous times, the Federal Reserve, they've already had to cut numerous times as well, and we've only had one rate cut so far here. So it's not unfair to paint a picture that the economic backdrop here is still a relatively benign environment, and there's a lot of companies that are still in good places here, albeit some people are paying up for that, and those valuations are still, in some people's eyes, a little bit toppy.
Benign, I guess it can mean a positive or kind of a negative, but in this case, let's call it a positive. Adam, thank you for joining me, and thank you for listening to the Bloomberg Australia podcast. I'm Rebecca Jones. This episode was recorded on the traditional lands of the Wurundjeri and Gadigal people of the Kulin and Eora Nation. It was produced by Paul Allen and edited by Chris Burke and Ainsley Chandler. Don't forget to follow and review the show wherever you get your podcasts, and sign up for Bloomberg's free daily newsletter, Australia Briefing. Go to bloomberg.com to subscribe.